Hello, everybody. Kirk Spano, Investing 2020s, and we're going to talk debt ceiling and what's going to come out of it today and put together a summer game plan. So first off, everybody likes to squawk about the debt ceiling. All the breathy and breathless TV personalities. What if the U.S. defaults? Okay, well, here's the answer. We're fucked. Okay, let's get that out of the way. Done. So why bother thinking that it could even happen? If it happens, then we need to take pitchforks and drive every single politician out of Washington, D.C., and then make me the emperor, and it'll all get better. Pretty easy. I'm the only one that could really help then, because I'm the greatest. I'm the best. In fact, there's nobody as smart as me, and nobody could ever possibly think. Okay, sorry. Yeah. Almost got carried away there. It would have been funny. I promise it would have been funny. Now, look, the real problem isn't the debt ceiling and the possibility of default. The real problem is what happens afterwards. The United States is running on fumes because we haven't been able to raise money by issuing treasury debt. So once the debt ceiling is lifted, that means that the government has to refill its coffers by issuing treasury debt. That money comes out of the financial system, largely from the banks, who buy a lot of short-term treasuries, 90 days, 6 months, a year, 2 years. And some of the dumb banks buy the longer-term debt and then get burned by it and become insolvent. There probably isn't a lot of them left. However, those same banks, a lot of them are very leveraged to commercial real estate. And if you took a look at Bloomberg yesterday, and I think I posted it in the chat room, there was a great article from Bloomberg. In the article, Bloomberg takes a look at Los Angeles's distressed downtown real estate. In the last couple of weeks, I talked to you about what I saw in San Francisco. Here in Los Angeles, what happened is that they built, they refinanced, and they ended up having overcapacity in commercial real estate. Right now, this building, gas company building, is in receivership, $465 million debt. My guess is that the building is worth between 100 and 200 million. Same thing is going on here and here. But wait, there's more. This building, probably worth 100 million or more less than what the debt is. Union Bank, same thing. Just sold for half its 2010 price. Think that through. It was worth 200 million in 2010. Here we are 13 years later, it's sold for half. Now, part of that is the fact that they have vacancy running at over 30%. But the other part is what I've talked about with you from the private investor standpoint is to convert these buildings, to remodel them, to redevelop them, costs a lot of money, especially if you move towards residential real estate. So all told, you have a couple $1 billion just in downtown Los Angeles that is way underwater. In Milwaukee, we had the third biggest office building in Milwaukee, 35 stories, go into bankruptcy late last year, and it got bought out of bankruptcy about a month ago. I don't believe that the deal has closed yet, but it was court approved a few weeks ago. That 35-story office building, they're going to put in 355 luxury apartments. And it's a great location. It's absolutely the right thing to do where it's located. It's on the Riverwalk. It's close to where the Bucks play. It's close to the lakefront. It's close to the business district. It is a great residential development to put right in the middle of several office buildings and all sorts of commercial development, restaurants, shops, and everything else. Need to happen all over the country to the tune of billions and billions, hundreds of billions of dollars. It's going to be a slow grind because what do we know about the labor that has to do that? We're not going to have enough. So if you're a skilled tradesperson, or if you're 21 or 20 years old and trying to figure out what to do with your life, man, learn how to get into the trades because they are going to be making money hand over fist for at least the next decade, probably longer. You'll just have to shift your skills to go with how green energy and everything else develops. And then if you invest well to boot, wow. So between nurses and skilled trades, man, I don't know what else I can tell younger people. Do those things, get a minor in business, take enough math and history, and you will make some amazing decisions with that money that you're making. Share that with the people in your family who are trying to figure this out. In any case, the banks are struggling because of this. It's all over America. So between the treasuries that we're going to have to sell to raise money for the government, sucking money out of the financial system, the real estate problem that we have, and what did the Fed start doing about a year or so ago? Quantitative tightening. So we have over the next year $1 trillion, unless they back off, coming out of the financial system due to quantitative tightening, roughly $1 trillion of new treasury issuance. And not that it wasn't going to happen anyway, but it all gets condensed into a short period of time, adding pressure to the system. The real estate transition that's going to go on for about the next 2 years is also going to put strain on the banks, who won't lend as much. Elon Musk warned about that. He said for about the next year, people are going to have a harder time financing cars, and that's going to put a little pressure on the car companies. Now, I think it makes it harder for Tesla the most because they're at the higher end across the board. So some of your cheaper car makes maybe do a little bit better. Maybe people buy the ICE vehicles to save $10,000 on sticker, and then they just hope that gasoline doesn't get too much more expensive. So what we have are all these things happening at once. We have the banks tightening up, we have quantitative tightening, and we have the government having to suck money out of the financial system, crowding out, right? You've heard the term crowding out over the next couple of quarters. And then there's this other thing. During the summer, usually liquidity dries up a bit in the stock market anyway for about 10 or 12 weeks because everybody's on vacation from Memorial Day to Labor Day. We get some huge corrections in August historically. Why? Because it's a low liquidity period and the shorts can come in and whack anything that they think needs to be whacked. Well, I'll tell you, I think the thing they're going to whack is going to be the S&P 500. It's easy for them to do using futures and options on SPY. And now that the tech is pretty much run up to about as high as it should run up, not as high as it can run up, just as high as it should, because it's all expensive again, with the handful of exceptions. NVIDIA ran up a ton today. I'm going to show you a neat little chart here in a second. Microsoft has been running up. Meta has been running up. Apple is still strong. You know, this tech rally probably has a ways to go, but in a weak market, a low liquidity market, maybe it just holds on to its numbers while everybody else suffers. Found a tweet, the great chart. When the NASDAQ 100 sets a new 52-week high after 6 months without one, it's been up 14 out of 14 times. Now, that's not a great sample size, right? 14 can't be a great sample size, but probably QQQ is higher in 12 months. It could be higher by 1%, like here, or a single digit percentage, like here and here and here. What I think probably happens is there's a breather on QQQ and a small correction, 5 or 10%. Could be 20 because so many of them are in the S&P 500. But what really gets hurt is the S&P 500 for the 420 stocks that aren't in QQQ. So if we get that breather over the summer, if we get a summer correction in SPY and it goes down to 3,800 or 3,600 or 3,200 or 3,000 or 2,800, whatever the number is, you don't go out and buy SPY. In fact, I'm building a short position in SPY right now. It just started. My first little nibble a couple of weeks ago, a little bit more yesterday. Probably if we get a little rally on the bogus debt ceiling solution, if we get a little rally on the news when it comes out, I'll probably buy a few more puts, because as soon as they start issuing treasuries, which will be within days, stock market loses a source of liquidity. People who otherwise would have invested in stocks will start buying bonds, especially since the interest rate's probably going to be, a solid 4%, maybe 5%. And people are scared. What I believe is going to happen is we're going to see a coiling of the spring over the next several months. And then it releases into a major rally next year, which could start by the end of this year. So what I have talked to you about since the start of the year, we are basically on track. The market's chopped along. I said that we'd get a correction in the middle of the year. I thought the bottom would be around Labor Day sometime. All these things are still in play. None of the scenarios I've discussed, especially my core scenario, my primary scenario, none of that's off the table yet. Market's just been chopping around since that initial rally the first couple of weeks of the year. That's 4 months. Market is just chopped. It either has to break out soon or it has to break down soon. I'm on the side that it probably breaks down, but that during that period, we'll start to get price discovery. And as things rotate, as winners and losers are parsed out, the winners are going to get all the money from the investors as liquidity slowly returns to normal. And especially if by early next year, they lower rates and reduce quantitative tightening. Keep an eye on quantitative tightening more than the interest rates. Probably the Fed funds rate has to come back down to about 3% in time. I don't know how fast it'll happen, but because of the debt of the government, before we get to a balanced budget, maybe a decade from now, have to keep rates down to around 3, so that the real rate paid by the government versus inflation is close to 0. The government needs the real interest rate, which is the nominal rate minus inflation, to be close to 0. Right now, the government's hemorrhaging money on interest payments, which have over doubled in the last couple of years, really the last year and a half, and that can't last. So you will see the Fed funds rate down to around 3% at some point in the not too distant future. Do we get back down to 0 again? I don't know. Depends on how bad the baby boomer bust is down the road. I suspect we are heading for a mega boom in the economy starting just a few years from now. As the price of energy comes down, because we build out more alternative energy, as supply chains continue to become more resilient, and hopefully we are smart enough to add to the labor force through some sort of an immigration policy deal. We'll see. So it's important that you're familiar with the plug and play list, because we have a lot of millionaire maker stocks on that list. We really do. To me, the list of stocks that we have is the best one I've ever had in my career. I fully expect to go from 7 figures to 8 figures off of this list. So let's talk about the first one, Ametis. Another press release today. 3 weeks ago, remember I told you, prepare for a series of press releases from them. And I would point out that in the 3 weeks I pounded the table for you to buy Ametis, that it has outperformed today's darling by quite a bit. This blue line is NVIDIA. That orange line is Ametis. So since I met with the management, which was actually here, there you go. So while everybody can go, whoa, NVIDIA, Ametis. Here's my question for you. Over the next 3 or 4 or 5 years, do you think gigantic NVIDIA in a gigantic market that's drawing gigantic competition is going to outperform teeny tiny Ametis, which is in a gigantic market and it has nearly a monopoly in California, which would be like, 6th biggest country, whatever it is, big country, and has barriers to competition because of government policy. Oh, and by the way, the government probably wants to control AI a bit, but they want as much biofuel and carbon capture as they can get. What do you think these charts will look like 3 years from now? Do you think Ametis wins or do you think NVIDIA wins? I'll take Ametis and I'll spot you today's gain in NVIDIA. So what did NVIDIA go up today? About 20%. I will start Ametis. There you go. NVIDIA's up 26%. We'll do this like a race where the faster guy starts behind you. So it's you against some fast guy. He says, I'll give you a head start. I will start Ametis 26% behind NVIDIA and take Ametis in that race. Other companies on our list. Well, we've got AST Space Mobile, and this is a summary from an investor presentation that was done today. There's some important points here. So I will put this in the chat room. In the chat, give you the link so you can click on over to it. One of the things that is interesting to me is that these satellites are already basically capable to do 6G when it comes out, because most of the functionality is on the ground, right? The satellites are basically just telecommunications towers. It's not the technology of the 5G or 6G or 4G LTE that's up there. That's on the ground. This is just relaying a signal. By 2025, it looks like they will have 25 satellites up there to cover most of the planet. They'll have to add more over time to cover the rest of the oceans and the poles, but of the populated part of the planet, they will have coverage in 2025 for most of it. What is this worth? Well, it's $1 trillion a year industry. Companies only valued at what, a couple billion? Not even 1 billion. ASTS is down to 1 billion market cap, with a short interest over 30%. That's a bigger short interest than Ametis has. And Ametis AMTX is starting to fight through that already. These short squeezes could be epic. Somebody asked me in the chat room today, what's my percentage in AST Space Mobile? I said, it doesn't matter. You and me are different. It's the wrong question to ask. Stuck in the old school way of doing things, thinking too much like Wall Street and the people who spin narratives that are meant to screw you up. Think about it from your portfolio. How much risk can you take? And ultimately, my answer was, I have my core position at this point, but I have saved room so that when the upward momentum starts in earnest, I can buy calls and I can put on a tactical long position. With virtually all of our small cap stocks in the next month or two, you should have your full core position. You should be buying stock or selling puts for July, probably, maybe August, because you want your full core position, whatever that is for you, whether that's 1%, 2%, 3%, 4% of your portfolio. What are your goals? How much volatility in your balance can you withstand before it keeps you up at night? I have more tolerance for that than probably almost anybody else. I play poker. I know I'm going to be short stacked once in a while. I know that people hate to be down 50% on a position, but I'll tell you this. I won another poker tournament after losing 3/4 of my chips in the first couple hours. How can that happen? Well, it happens like this. People choose to gamble with you even when you're way ahead. Sometimes they do something called sucking out. They get a card that is extremely unlikely for them to get, and they beat you. Sometimes it happens a few times in a row. If you've ever played blackjack and you've engaged in that age-old theory of doubling your bet every time you lose, only to eventually go broke because the bets got so big you couldn't put any more out there, it happens. Sometimes you lose when you're a huge favorite, and then things flip the other way around. When I was down to 1/4 of my chip stack, got a pair of kings, got all my chips in the middle against a guy who had an ace queen. And another guy that had an ace. Another guy had an ace jack. So king versus ace queen and ace jack. That's pretty good for me. Ace comes out, I lose. The 2 of them are gone. My kings block a lot of their straights. And I ended up winning the hand, tripling up. Plus the blinds and antes and whatnot. I was almost back to start. Almost had my whole chip stack back. Same thing happens with stocks all the time. Sometimes the shorts can beat the heck out of something way more than it makes sense fundamentally, just because they have the power in the market at the moment, due to margin, due to ganging up because they use Discord or Reddit to gang up. If you don't believe that that's happening, then you should not manage your own money, because I guarantee you that it's happening. I watch it happen. I've been invited to participate. Somebody asked me a minute ago in the chat, am I buying more AT&T? I'm not. That doesn't mean that you can't. AT&T is obscenely cheap right now. Obscenely cheap. People aren't giving it any potential to grow, and to cut expenses, and to cut expenses, and to increase margins, and to find new revenues. They don't know that AST Space Mobile is hooked up with AT&T, which is going to give them a huge advantage for a couple of years over all the competitors. It's going to allow them to do international deals with foreign telecom companies so that AT&T can increase its footprint globally. People still don't understand that they have the ability to become a Roku competitor right on the line as they expand fiber. You know, there's a lot to like about AT&T, but I'm not buying it. Why? I've got as much as I want. So until it starts to go up, I'm not going to bother buying it. I don't know how low this can go. I mean, it seems like it should have been done selling off a long time ago. And yet, people throw hate at it. Now, will management cut the dividend again because the yield is up to 7%? I don't know. But if they do, I think it's pretty much priced in. And after that, at that point, well, gee whiz, if they cut the dividend, that makes that company even more healthy. I really don't think there's anything to not like about AT&T at this price, but I thought the same thing at 23, 22, 20, 19, 18, 17, 16. Sometimes the market can be irrational and emotional for a long time. So for me, I'm just going to wait for it to turn up. But when it turns up, maybe I'll buy more. Now, if you don't own AT&T, especially if you're a dividend investor or you consider yourself a long-term investor, and you like having assets that are irreplaceable, have huge moats, essentially can't go bankrupt, and you're willing to wait for the rally and the bull cycle whenever it's going to get here, then yeah, you can buy AT&T right now. But I have made the decision, and I've made this decision multiple times in my career, and then I keep getting sucked back into my value investing ways because, right, AT&T is a value right now, deep value. But as I have to contend with people's psychology, and frankly, I don't like how it feels when something goes down any more than you do, I'm just trying to deal with stocks that are going up more often, a little bit more momentum based. So some combination of value plus momentum I'm trying to employ. and I have to balance those things. And since I can't see your portfolio, you have to balance those things. So is AT&T a value worth buying? Yes. Is there any upward momentum on it yet? Not even a lick. So between now and the time it turns up, which will probably be in like 20 minutes now that I've talked about it, I'm just going to wait until I see it turn up. But if you have no AT&T and you want AT&T, and I probably think you should have AT&T if you are anywhere near retirement, or you just want something in your portfolio kicking off a big dividend that you can use that money to buy other stocks, go ahead, start scaling in. But if you're like me and you already have a hunk and it's at like a $20 cost basis after premiums, maybe 19, I'm not really sure. I'm not buying it yet. It's not a big enough gap for me. 19 to 15, yeah, I guess. I mean, I could argue that I could buy it right now, but it's not going up right now. And I don't want to engage in a martingale thing, right? Double down, double down, double down until I see that it's for sure bottomed. I mean, get into the jitterbug zone. This does not look like, right? That does not look like the jitterbug zone. That did, then it fell off again. So I was buying it in here, and the dang thing did this to me. So what do? Do I keep adding to it as it goes down? No, I'll wait. What if it gets to 12? What if the haters can get it all the way down to $8 or $9 a share? I mean, there is an absolute price where I think I would buy this, but at this point, I probably have to lower my bottom fishing price, right? The market's telling me that I have to. And the same thing can be said for Warner Brothers Discovery, right? It's been in the jitterbug zone. Is it going to break in the single digits? It might. What did it bottom at? 9? I probably have to buy more of it down there. I've got a pretty good position though. So for me, it's more of a function of time. But if you're new to Warner Brothers Discovery and you know what I know, which is that the assets are worth triple or quadruple the market cap minus debt, which has been coming down fast, right? Warner Brothers Discovery is going to get back to 30 or 40 or maybe even $50 a share again someday. How far away is someday? I don't know. But I know that Google and Amazon, Apple, and Comcast are all looking to acquire. And the only two players in town, right? The only two games in town are Warner Brothers Discovery and Paramount. So actually in one of the Stocks of the Week's articles, I just put Paramount and Warner Brothers Discovery together because I think you should own them both because now they're incredibly similar. Now that Paramount has cut their dividend down to almost nothing, they're similar. What Sherry Redstone did when she cut that dividend is she set that company up to package itself to be sold. Why do I say that? Because without paying out that big fat dividend, she could just start wiping out debt and buying back shares. And just start packaging this up for a buyer. Paramount probably going to also get to around 30, 40, $50 a share again. And it might go higher. Because when you take a look at the intellectual property and the content, fairly similar to Warner Brothers Discovery. You know, you can argue either way. And I'm not really sure. I'm not an expert on which library is the most valuable. But in my head, the rumors out there right now are that Comcast is going to buy Warner Brothers Discovery. It doesn't make sense to me, but it's possible. The rumor last year was that Comcast was going to buy Paramount. And then, you know, I don't think the price was high enough for Sherry Redstone to bail. So Sherry knows there's interest out there for her company. She's like, okay, what can I do to get the highest price on the shares which I own? Well, the answer is tighten up the finances. Let this thing become very profitable and growing again. And that Walmart deal is a big part of them growing. And see who comes knocking with the biggest check. Well, Comcast can write a pretty big check. However, Apple, Amazon, and Google can write a bigger check. To me, I think that those three make the most sense because they're already in the game. They need libraries. They need production facilities. And for them to drop 30, 40, $50 billion and do it partially in shares, not a big deal. So when you consider that we're probably going into a tough stretch in the market, and if we don't, if the market rallies up, then we're just going to get a kaboom at some point. I want to focus on my best ideas, a Metas, right? You know, your NVIDIAs of the world are worth investing in too, but I've actually trimmed into this rally. I actually trimmed on both sides. You know, when you trim on both sides, it's because you trim beforehand in case the news is bad. And then if the news is good, you know, you trim more. So you get an average price, and that's fine. Those big QQQ stocks, you could just buy QQQ on a broader pullback. And since I think that's coming again, but that'll immediately be followed by a rally, there you go. Now, if too many people think the way I think, then we'll get the rally first. And then it'll go up, down, up, rather than down up, right? If the debt ceiling rally really breaks out, then we just have a different pattern. And you can deal with it either way that it happens. You don't have to be Nostracurcus. All right, I'll let you go with that in mind. I'll finish this up this afternoon, lay out the game plan. And as you go into summer, just remember, all those things that you do to have a good time in the summer, everybody in the market does it too. And that's why liquidity drains in the summer naturally every year. So with all these other things draining liquidity out of the market, just let it create opportunities for you. And I think you should expect to probably be fully invested by the end of the year. Again, unless we get a giant rally first, in which case you'll sell into that. We'll see. But stick with the companies that are truly outperforming. This is the narrative in the news. This is what really happened. Right. Talk to you again soon. Have a great Memorial Day weekend.